Good afternoon, everyone. It's Dr. K coming at you from this other side of the pond, the London side of the pond, and Gil over in Playa del Rey. And it's interesting market times as always. We've got a market that appears to be attempting a correction, but then we've seen this action all year. We've seen this type of action where there's a slew of bad news or selling pressure identified in major averages and leading stocks, but then the market will find its footing and then head higher. This is the age of QE. This form of QE, QE3, seems to be less potent than QE1 and QE2, given the lesser slope identified on the NASDAQ. Part of that is due to Apple Computer having topped. So if we actually look at the S&P 500, we'll see that the slope of ascent in the current QE3 manifestation is about the same as it's been in QE1 and QE2. So then one could make the case that perhaps this form of QE is not any weaker than the first two, based on the S&P 500, which is a fairly broad index. And what we do have this time around, however, is we have Japan on board. We've got, we've got basically all the central banks on board printing money. And Japan's level of printing is quite massive and significant. And it's, of course, affected the Japanese markets that have gone straight up, almost like a rocket relative to the way the Japanese market normally would be. And so right now, with QE in force, firing on all cylinders, the model accounts for this, like it accounted for QE in its early form in 2009, and fortunately the model was able to integrate QE into its algorithm, so it was able to do well up in 2009, 2010, and 2011. And 2012 has been the most challenging year on record. The amount of QE was switched to Operation Twist, and that created a lot of, that was not as powerful as QE, and so you had a lot of sideways trendless action in 2012. No real discernible trends came through, as opposed to 2011, when we did have a handful of discernible trends. Not many, but just a scant few that were enough to make all the difference in performance in 2011. And 2013 is seems to be a carryover of 2012. However, we do have QE3 on board, and therefore the last couple times that the market has come off and everything looked like it was going to head a lot lower, the market did find its footing and went higher. So the model is taking that into account, and everyone should know, therefore, that because of this, accounting for QE, this form of QE in 2013, the model is going to give the market a little bit more room on the downside before it switches to cash or sell signal. That means there's going to be a little bit more risk incurred, so that the model doesn't get knocked out of a good buy signal. And it also means that, as we've always said from the beginning, you have to pick your ETFs that are conducive to your risk tolerance levels. Some members opt for 3x, but some members are not going to be able to take the volatility and the drawdowns incurred in a 3x ETF, so they're going to opt for the 1 or the 2x. And just because the model remains on a buy doesn't mean you sit on your position, especially if you have, say, 100% of your allocated capital to MDM in a 3x. It doesn't mean you're going to sit in that, especially if it's going to violate your maximum risk percentage level. So always keep that in mind. And also, ideally, you want to be in an ETF where you're not going to get knocked out of the position, and you're going to be able to stay with the model signal. So, of course, every member has to find what is going to work best for them, and then localize on a 1x, 2x, or 3x ETF accordingly. Gil?
Yeah, I mean, my general view is that given the state of the leadership, there's really no reason to be long this market. I think the whole idea that you can buy and hold in this market. I know, last year buy and hold outperformed the model, and people will say, oh well, you have to just take a buy and hold approach. But I think buy and hold is something that becomes obvious in hindsight only, and the big danger in buy and hold is if that becomes your rigid strategy, I think you're going to get your head handed to you. One of the things I don't like about this current sell-off is I think that the market internals are a fair bit different than they were on the prior two sell-offs that we had earlier in the year. Just using the NASDAQ, we had this one here in late February, and then the one just a couple of weeks ago that quickly reversed and took the market to new highs. And this is essentially a bull trap right here. Looked very strong, had a follow-through day. Everybody was on market and uptrend. IBD was. The model went to a buy signal. And now you're correcting. I think this, no matter how you slice it, I think NASDAQ came off 4.3% or so. The S&P, not quite as much. It's trying to hold the 50-day moving average. And I think that's what's keeping the market up. You got divergence in the Dow with IBM getting clocked. But, all you're seeing today is another one of these drifts up. Now, whether this turns around and goes to new highs, I don't think you really know for sure. So I think you're almost forced to take a shorter time frame in the market, and that's basically been my approach. I know you guys know I've been talking about being very active trading in my own account in terms of taking 10% profits when I've had them and not really sticking around too long waiting for something to move a lot higher, because in most cases you just haven't seen that happen. So, a couple things to keep in mind here. What you're looking at here, this is a logical area for the market to rally from based on, one, the S&P hitting the 50-day moving average. So, you'd almost expect a bounce today on the basis of where the position of the index is here on the S&P, and also on the NASDAQ. While it has broken through the 50-day moving average, you have to consider that you have undercut this prior low, the early March or early April low, rather, I should say, and that sets up the rally. Now, maybe you head back up into the 50-day. Things that are driving the NASDAQ's outperformance today, I believe, are mostly Google, and I think this drags up a number of other big cap NASDAQ names. Let's just look at Google, for example. But look at the position here. What you're really doing, you're in this downward trend channel. Now you're towards the peak of the channel. Now, can you look at this as some sort of a breakdown that then becomes shortable and rallies up into the 50-day moving average? Perhaps, I think. But I think that you have to see how the thing rallies and see if it gives way. Right now, they're definitely buying the stock. Dr. K, is the volume up on there right now?
Let me check here.
I believe it is. Let me pull up my handy-dandy volume indicator. Yeah, you're running 382% above average. So that's a pretty strong move in the stock. And you can see on the weekly chart, this is what you're looking at. So it doesn't look all that strong. And yes, this could become shortable. I know some people ask about this as a short, and potentially it could be. So my feeling is that the short side is kind of hit and run right now. That's been my approach to it. A couple of things, I've been looking at. If any of you have been on the chat room, a couple of days ago I was talking about F5. You have this big gap down and a feeble rally, and you're breaking out of this inverse bear flag here. You can look at it on a weekly chart, but there's a 1 week upside move, and now we're breaking to new lows. I think the IBM news also makes this weaker, so that one's working today. Looking around also, Netflix watching the rally this morning, which is a logical bounce off of these prior lows. But if you look at this thing, this was in an allegedly high tide flag that kind of loosened up a bit and broke down through the 50-day moving average. You rallied right back into the 50-day moving average there, and this becomes shortable there, and now it's rolling back, bouncing off these lows. But I guess they come out with earnings when next week, and we'll see what happens between now and then. But it hasn't kept something like Apple from sailing off. What's that?
On the 23rd, they're supposed to report.
Yeah, so next week. So we'll see what happens there. But it may break down. But I thought that was a decent hit and run short off of the 50-day moving average there. So now the stock's trying to bounce back this morning, but I don't think there's much really in the way of volume, 14% above average. The other situation that everybody's always asking about is gold. And, here you have this breakdown. You're in a downtrend here, and then this sort of blast to the downside, and you're gapping down on huge volume. And now you're trying to rally back up. I wouldn't be stepping in and trying to buy gold here. I think you may head lower. That's a possibility. It's also a possibility that There's a little bit of a climactic low on the weekly chart, and you can see that you are getting some big volume support in the GLD. Now, interestingly, if we look at the gold futures, and as you came down on, I believe this was Monday, where you blew apart, the next day you saw a huge amount of volume, and they're saying that physical demand for gold is huge right now, and people are buying gold hand over fist. I saw one article that someone sent us that said that on the 17th of April, the U.S. Mint sold more gold on one day, physical gold, than it had in the prior 2 months. And I think that may be telling that there's a disconnect between paper gold and physical gold. And you might consider the idea that at some point, is there going to be enough physical gold to back all the paper gold that's out there? And if that's the case, maybe it isn't, and people may come to the realization that if doo-doo is really going to hit the fan, that they don't want to be in paper metals, and the only real safe place to be is going to be in physical. And so you're seeing the two kind of disconnect. Does that tell us that we're in an impending crisis unknown at the current time? You have all this QE in the system, and it strikes me as very interesting that, Dr. Hay, in 1999, what were interest rates? What did the Fed bring the rates down to, the discount rate? Was it like 2 or 3%?
Yeah.
Yeah. Okay, so back then they injected liquidity into the system with by bringing the discount rate to like 2 to 3%, and we had the huge bubble market in 1999. Now you have this phenomenon where the Fed has driven rates down to nothing, and you still haven't brought on this massive upside bubble where you see everything on the planet running higher, and upside movement in leading stocks has been very difficult. And in fact, I think that can-slim type investing has had some problems in 2013. I think 2012 was similar issues. Would you say so, Dr. K?
Yeah, I would. I think that I wanted to make a comment about this whole buy and hold thing before we continue. This whole thing is very 2020 in hindsight, and
yes.
As far as 2012 was an aberration. Yes, buy and hold outperformed, but then 2012 comes along. Thankfully, a year like that comes along once every 30, 40, 50 years. It's an aberration, and clearly it was a result of a lot of manipulation on behalf of the Fed, and really no strong trends in either direction as a result. So, as far as buying stocks in this kind of environment, there's nothing to buy. And in fact, most of this year, there's really not been really anything that, there's been a few names that had pocket pivots, that had setups, but it's a riskier environment. The risk is definitely prevalent. And so if people want to utilize the MDM and then go with the signals and knowing that there's going to be a little more risk incurred because it doesn't want to get knocked out of its buy signal, just because the market has a small reaction, that's fine, but always understand your downside risk in getting involved in any of these instruments. And we are in unusual times, and that doesn't mean that we're not going to get a great trend, because 2011, as I pointed out, was one of those years where the first half of it, all the way up to July, just wore people out. And by July, people were just dropping off, just throwing in the towel. You could see it in the news. A lot of people just were sick of the market. Then August came along, and a lot of people got knocked out in August, but we were able to capitalize on those trends, and in a very profitable way, which more than offset all the little nicks and scrapes from the first 7 months of the year. So always keep that in mind. And I gave a brief risk template on how one might manage their position sizes in this kind of environment where, say, there's more risk and you might get more false trades than true trades. False, of course, is defined by losses versus true defined by profits. So in terms of you all probably know about the turtle traders. They always had a risk assessment in terms of position sizes, and if they had a string of bad trades, they would always be ahead of that by downsizing the size of their position very quickly, very aggressively, so that if you did have a bad situation where you had 5 or more false trades in a row, then at least your account would lose a lot less as a result. So
I think from a practical aspect, you have to control that. If you're seeing evidence that the model's having some issues, then I think you do have to control that. Especially if you're managing money for others. I don't think you just throw caution to the wind and come blasting in. signal after signal and just allow the situation to deteriorate. You have to be able to come back in smaller steps. It's going to take you a little bit longer if you've been getting hit as a result of a number of signals. But remember that Dr. K and I have to discuss these issues and come to a mutually agreeable solution. And one of the things that we've done is take a short-term view of the market using a sort of a short-term overlay that we've implemented. You know, you guys know about this with the 620 crossbow thing that we use, and that has helped us to limit risk. But it doesn't mean that we don't take losses on the bad signals. But yeah, so it's a tough environment, and I think you have to be careful and not just hurling yourself in every time, especially if you have a series of bad signals where you get kicked around a little bit. So so it's really more. There's a practical aspect. If you really want to run a high-risk account and be a purist with the model, and you believe that at some point there will be a massive signal that will make up for the little nicks and cuts, then that's another story. But if you have money that you really can't afford to see 70% disappear, I think you have to take some steps on a practical basis to limit some of that. And so I think that's really what we're talking about in that piece. Some people were questioning whether that contradicts the whole aspect of trend following. I think you have to make some adjustments along the way, particularly in such a bizarre environment. And like I said, if this were 1999, gosh, imagine what the market would be doing, Dr. K, if this were 1999 with 0% interest rates, because you had a massive move during that period, and interest rates were 3% or so. Anyways, somebody's asking here, I'm going to throw this question, I don't know what this means. Dr. K, where is your risk template located?
In the upper humerus of my, I don't know these biological names, but you get the idea.
In the the cerebral cortex. So anyways,
yeah,
we need
I love Excel. Excel's got all the spreadsheets, and I've always been a big Excel fan because it's programmable at all. So it's I recommend Excel to anyone who wants to do their own tracking and work and developing their strategies. I think Excel's Excel. It's the premier program because it does everything and then some.
So that's where your risk template is. So it's not anywhere on the site. I don't even understand exactly what a risk template is. I think everybody has to determine their own risk template. I'm going to go through a couple of questions real quick before I decide what else we want to cover here as I run through my list of names and run some screens in real time as we're going through this today. And like I said, you're in a logical place to bounce, and you are bouncing, and I don't think that it's an all-clear signal. I think you have to just kind of watch and see how this bounce takes place or plays out, because I think there's really nothing I see that's viable. We'll get to some of the questions on that. But first, we'll start out with the inevitable short sale question. Somebody's asking me, ASIO appears to be breaking down. Next key area of support, 200 DMA. Well, logically, I guess you would say so, because the top of the base certainly didn't hold up. But it's broken down to the 50-day, and you're failing on the breakout. It's done this before, and it never really tends to break out or blow out to the downside. So that would be your next level of support if you're short it. That's the only thing I would say. But you remember, these sorts of situations, what happens on a late-stage failed base, which I think is what we would call this, if this is really going to turn into a failure that results in further downside, you'll see a bounce off the 200-day. It breaks down once through the 50-day, and then it'll have some rallies back up into it, and those give you a chance to short into those particular upside movements. So that's what you'd be looking for there. Somebody's asking, Soda has over 40% of the float short. How does it look for setup short squeeze if market gets its footing? Well, all you can do is look at the chart and ask yourself where you are in position of the chart. We don't have a crystal ball or anything that's going to tell you whether it's actually going to move up or not. I don't consider it a positive that it's a very loose pattern, and it tries to break out and it fails. So now what you're looking at is support at the 50-day moving average, and resistance maybe up in the 54 level, but this is a little bit suspect, this kind of move. And if the market's weak, this is a thinner stock, more volatile, it's going to break down faster. So if you had the idea that, okay, this is going to be a short squeeze if the market rallies, number one, you're assuming that the market is going to rally, and number two, you're assuming that shorts maybe aren't right. I mean, there are some studies that show that stocks with a lot of short interest can often head lower in most cases, right, Dr. K? Have you seen anything like that? I saw one study where it showed that actually stocks with large short interest tend to go lower, not higher. So keep that in mind. But if you felt lucky, as Clint Eastwood said in this famous movie Dirty Harry, do you feel lucky, punk? You could say to yourself, well, if you are feeling lucky, the stock's trading at 50.75 right now. The 50-day is 49.63, a little bit over 2% lower. So that could be your downside stop if you think that there's potential for this thing to get a short squeeze. And that's possible. So I know there's been huge short interest in the stock, and I've talked about that a few times in soda. People asking about short ideas. A little wary of the short side just right now. I think, like I said, it's a hit-and-run situation. So you could have come after a VMware, but you're not going to short it now. It comes and tests this low, and now it looks to me like it has to come back to the 50-day. So you might try putting it out at the 50-day moving average. But again, I think the short side here is a little bit on the early side. It's mostly a hit-and-run affair. So we're not going to be interested in putting out short sale alerts if we don't see what we think are proper setups in what we believe is a major change of trend. There's still a probability that the market could find its footing and head higher just on the basis of this whole QE melt-up sort of stuff, and I think people have to take that into account. So, you know, I'm not going to run into everything that's already down. You know, EMC, is that a short here? No, this thing's extended to the downside, and it's not even clear to me that, you know, this was necessarily a big leader that's going to, you're now going to see funds just rush out of the stock and clobber it, because remember the whole concept behind shorting is you want to go into stocks where everybody is piled in, where everybody believes that it's the new bulletproof upside play that all you have to do is own the stock and you're going to be fine, you know, for the rest of your life. Yeah, and it's basically pile in, pile out. That's the concept. So when I'm looking for short sale ideas, I'm looking for these stocks that were big leaders, where you're going to see hopefully these stock just break down, and the institutional ownership within the stock just keeps coming out, and that's really what's happened with Apple. So, you know, Apple breaking down through this big neckline. If we draw this over here, let's see, where's my handy dandy drawing tool? If we draw this, here's a neckline here, and let's see, come on, get in there, right there. Here you go. So you're breaking down it through this neckline. Now you got earnings coming out next week, so I think that throws a different wrinkle into the whole situation, and you have to take that into account because it's a little bit obvious here. You're coming down into the structure, so it would be logical that you might get a bounce. My inclination would be that if you were shorting it up in here, that you want to back off and wait till earnings come out and see where it goes from there, because there's too much risk, in my view, in just coming in and shorting anything here. So, and somebody mentioning, let's get rid of all of these. FTNT, you know, this is undercutting these lows, so I don't really see any of these really as short sale situations that I would be interested in playing. Somebody's asking, Dr. K, which market timing results chart should I use to compare against my actual progress in SQQQ, TQQQ?
Which market timing results chart? What does he mean by that?
I would say, I guess.
I would for SQQQ, well, for TQQQ, I mean that's 3 times the NASDAQ 100. So I would use the first table that shows the NASDAQ Composite results against the MDM, because ultimately, you know, that NASDAQ Composite is a fairly close mirror to the NASDAQ 100. And so if you're using TQQQ, SQQQ, that's going to be, you know, roughly 3x of what you see in the NASDAQ Composite. Not perfect, but it's relatively close. And if you pull up a chart of the NASDAQ 100 and you compare it to the NASDAQ Composite, you'll see what I mean. The correlation is quite high.
More questions on shorts. So I guess, you know, it tells you that's probably going to tell you the market needs to rally here. Everybody wants to short. I mean, I talked about F5. That's working a little bit here, but nothing spectacular just yet. And also, people are mentioning, VMware, the cloud stocks all look shortable. And my preference, though, would be to short them into these rallies. But notice how the rallies look pretty good, and they definitely will push past the moving average and then give way. Apple did the same thing when it rallied above its 50-day. So the other one people are looking at is CRM. And you can see here you've undercut these lows. So I think on this you really want to be shorting into rallies up in here if you get them. You don't want to be. I don't think you can be reactive when it comes to shorting. In other words, you see things down a couple, 3 days, and you want to jump all over them. You're setting yourself up, particularly if you're undercutting prior lows, just to get kicked. And I don't think that that's a smart way to approach short selling. You have to be anticipatory, not reactive or reactionary. You see things coming down, and everybody wants to go short, and I think that's when people get smacked. You have to anticipate these moves. And in most cases, if you are anticipating them, the way I look at it, you get 2 or 3 days down, and it's basically hit and run shorting as far as I'm concerned. So I don't really see anything that I consider a long-term shorting setup until we can determine whether or not we are in a bear trend. You could just be in a sloppy, choppy environment for a period of time where you go nowhere except just getting yourself nicked to death, and I think that's kind of what we might be looking at. QE sort of acts as this bizarre force that mutes any downside selling, and I think prevents a real trend from taking hold. And we'll see whether, where this goes. But my guess is when QE finally does come to an end, you're going to see a big gap down in the market. So you're going to have to play guess the gap. F5, I know, is reporting earnings next week, but they already pre-announced that their earnings are going to suck. So I think there's not too much risk there. But you never know. They might try to rally the stock into after earnings. Google beat on earnings but missed on revenues. Who would have known it would be up as much as it is today? So I think that's the risk in being short in this environment. That's the risk in being long in this environment. And so I simply take the view that, number one, I'm going to employ hit-and-run short selling because I'm very much oriented towards trading on a day trading basis or a short-term, 2-3 day basis. On the short side, on the long side, I'm not really oriented that way, so I'll pretty much refrain from going long. So I kind of look at this as a market where I'd rather be on the outside or out of the market wishing I were in as opposed to being in wishing I were out, because I think there's just too much risk right now. Somebody says buy volume is up today on UA, Under Armour. Let's see. Looks like they're going to take a few minutes to bring up my chart. Come on, eSignal, don't go to sleep on me now. Well, this is impressive. Yeah, here's a big kind of a cup formation, and maybe it's failing, maybe it isn't. But is it shortable? I don't know. This stock's a little bit thinner. I tried trading it a couple times. In fact, I think I did try shorting it somewhere in here, and it's a little bit thin, so I haven't really focused on that as the short sale target. But if you felt like taking a stab, you're 2 points up from here or so is your stop. But it's a bit of a thin stock, so and I don't know if it's setting up for an uptrend. It's just a big kind of cup formation and coming up, so I can't tell you what it's setting up for. It's really not in a viable position. Dr. K, are pocket pivots valid on ETFs like TZA?
No, don't use pocket pivots for ETFs.
Yeah, I mean, you can't really remember broad indexes and ETFs that encompass either a broad index or a broad sector don't really reflect the sort of action that you see in a particular stock that implies accumulation by institutions. So, or at least subtle accumulation by institutions, which is what we believe the pocket pivot indicates when you see them. So obviously, I don't think it translates over to ETFs. So if I hear, says somebody, in the chop zone of the current market, you need to be hit and run traders, and if you want the big move stocks shown in your books, we need a decent correction and follow through day before we can discover those types of stocks. I think they're far and few between. I mean, LinkedIn has been a decent play in terms of being able to run the stock, but these are far and few between. So what you're hearing is this is a difficult environment in general. If your stock selection is half good and half lucky, and you get into the right name that has a sustained uptrend, if you did buy, say, this one down in here, that's had a nice move. Biogen has had a nice move. So if you find them, they're far and few between. I think you have to kiss a lot of frogs before you get to one of these. You've been able to play these, but for the market, I think, to be much more fertile than it has been, you sort of need to clear the decks. That's what I would like to see, but the market never does what I want it to do, so there's no reason to expect it's going to now. We could just be in this very difficult environment, but that's my feeling there, because it's been a very much a hit or miss affair unless you're in the right particular area of the market. So ultra short. This is another one that's relatively thin, and thing runs up. These guys declared a 3% buyback, and maybe that's what drove it higher, because you never really saw any massive volume buying, but it has drifted up and ran right into the 50-day. So if you had wanted to test it out on the short side, you could have, but this is not a stock that I'm really into shorting. It's a little bit funky and very squirrely. Since it seems like they can get it moving in one direction or another. So it's not really one I've liked. So I'm not going to tell you that you have to run in here and short this one. Open, I assume the 50 SMA, a 50-day moving average, and the 65 EMA. We don't really use that per se, but it's violated the 50-day, so we don't use violations of the 65-day exponential. As you know, that's just a moving average I've used on the short side in some environments, but I don't think that in general you want to rely on that necessarily as violations of it as sell signals. But yeah, you have violated the 50-day moving average, but also you notice here Dr. K's rule about high volume gap downs off of the peak. You'd probably just be selling it, right, Dr. K?
Yes, absolutely. Just be really careful when you start to see gap. If you see a gap down at the open, I'm more prone to just selling it out completely, or depending on the situation, it's always contextual. See, so while I might just sell it out the open, I might take a wait and see approach. In other words, I'm going to follow the stock intraday, and if it sometimes when it gaps down, mini gaps, it rallies, and my sell point will be if it comes back around and breaks the low of that particular day, then I'm out. So in other words, it gives me a little more room and a second chance. I'm giving the stock a second chance to maybe fill the gap. And this applies to mini gaps. If it's a big gap, as in relative to this chart, it's a clear gap down, no questions asked. I'm just asked. I'm always out of the position at the open. I don't really want to mess with it. In stocks, sometimes if you're unfortunate enough to be in a stock that lost 10, 15, 20% or more of its value, then no questions asked, I would be out of the position right at the open.
Somebody's asking, what is the rule of three? And you guys will hear me refer to this on occasion. And the rule of three is something that Bill O'Neill used to talk about, and it was based on the idea that for people to really, for something to embed in somebody's brain, they have to see it at least 3 times or hear it at least 3 times. And they don't really fully memorize it until they've heard or seen it 6, 7 times. But in the market, the rule of 3 applies to when the crowd sees something happen 3 times. Usually by then it's become so obvious that the next time we'll fake them out. And we might consider that you had this sharp pullback here, but I'm going to start out with this year. And if we look at one pullback that went to new highs, second pullback went to new highs, and now here's a third pullback. And the expectation by the crowd may be that this is going to go to new highs again, and this may set up. Now the crowd is leaning the wrong way. The expectations of the crowd are that it's going to move higher, and thus they get faked out on the basis of the rule of 3. And there's a lot of other ways that we use it. I remember in the past, if a stock would break out and fail twice, on the third one it might work, because by then the crowd is expecting it to fail once again. So that's really what the rule of 3 is about, and it's sort of, it's just a general rule. It's one of those O'Neillisms that Bill always used to utter, that you'd see it play out in practice, and there's different ways that it also plays out. Stocks, as they're correcting, might have 3 waves to the downside, and by the third one you've kind of washed it out and made the downside pretty obvious, and so that's part of say a corollary to the rule of 3. But there's a lot of applications of it, and you'll see us discuss it from time to time. Maybe this is one for you, Dr. K. Someone asks, I'm a newbie in trading the market. Based on your experience, is there a correlation between market direction / action and options expiration on the third Friday of the month?
No, nothing I've been able to really make any statistical profit out of. It's an interesting question, and yeah, I haven't seen a pattern there. So my answer is no.
Yeah.
Now, that said, if I haven't seen the pattern, it doesn't mean there's not a pattern. This stuff is dynamic. Markets change, and it's possible someone out there has seen a pattern. Sometimes I do get emails from there's a few of my friends that they really like to do a lot of market research, and we will trade ideas back and forth. Our styles are completely different, so oftentimes we don't have much overlap, but sometimes I'll say something or they'll say something that will further our knowledge, and also often will give me new direction to take my research in, just by being open source to other ideas and other methods. So I would always keep that in mind, in the spirit of doing all this research and in the spirit of expanding one's understanding of how markets work. Just because five people who you all say five people you all respect, and they came up with a no on a particular research item, don't exclude it from your vocabulary. Always keep it in the back of your mind that maybe markets will change, or maybe these guys are wrong, or maybe they weren't that interested in looking into it, so didn't look into it in as much depth as they should. And certainly I'm no exception to that. There's ideas that I've looked into on a more superficial level, and then was convinced that it's probably not going to work for what I'm doing. But what you're doing in your own research might be completely different, and therefore that idea that I didn't really research in full might be worth your effort to research in full, because you might be able to make use of it given your style.
Somebody says, I need to bring out my Stratocaster for all my future predictions. That indicator is so far the best in this market. Okay. Dr. K, can you implement the Stratocaster prediction tool into the MDM?
That sounds like the Ed Seykota bug. Ed Seykota showed me this bug on his computer screens when I was visiting his home, and the whole point was that bug where it's a random walk bug, and so wherever it goes on the chart is where the stock price is going to go.
There you go.
And his point was there's just a lot of these indicators out there that are kind of nonsensical. So it keeps things light. And this bug is very random, so it'll actually appear on his screen. Just that we were talking, and there's this bug started to crawl on his screen. Digitized bug.
Right.
And he's programmed all this stuff. Everything's programmed. It's all homemade. So of course it's the bug. His bug is very much a conversation bug, so to speak.
Let's see. Do you think there will be an end to QE, as you just said, or do you believe there may be a currency collapse instead? My personal view is that QE will end when the dollar collapses. End of story. And that'll put an end to QE, and the Fed will be left with no tools. When that happens, who knows? But that's my general view. They're just going to continue printing, and Bullard, the Fed head, his last name is Bullard. I hope I'm pronouncing that right. He was out the other day saying that they do have, headroom to increase their purchases. So my feeling is as the situation, if we start to see the economy deteriorate, and if we start to see liquidity issues in the system on a broad scale, say globally, the Fed is just going to continue printing. But they may find that their printing has very little traction, and in the process, they're trapped into just printing, and they trigger hyperinflation and then just a collapse in the dollar. My guess is they're not going to be able to engineer a soft landing. They talk about that, but Dr. Case, can you cite any period, and I'll just think about my own career over the last 23 years, I don't think I've ever seen a single period where the Fed engineered a soft landing. And I doubt very much if they're going to do it this time, particularly given how far off the charts they've gone with their quantitative easing. Dr. K, any comments there?
Well, yeah, in the 90s, we were in the midst of this continued bull trend, and so by virtue of all the forward momentum and by virtue of Greenspan lowering rates to make money a lot more free ahead of the year 2000 potential fiasco, they were able to engineer a soft landing by their definition. In other words, yes, the markets went up. Yes, people made a lot of money. It was a lot of prosperity, and they did get that soft landing because in the late 90s there were some serious setbacks at times, in the market averages, and that led a lot of headlines to say, this is the start of the big bear. And Greenspan's irrational exuberant speech in 1997 added fuel to that fire. So that when we saw that some fairly serious corrections, say in late 1998, or we also had the summer correction in 96, we had that more or less full year correction in 94. These were all periods where people were adding up, loading up on their short positions, or just exiting the market in total, and thinking that everything's going to blow apart. So that the Fed, that saying the market climbs a wall of worry was never more prevalent in the late 90s. And so yeah, I by their definition, that soft landing was achieved. But one could argue that the Fed should not have been meddling in the first place and creating basically a bubble of sorts, akin to what we saw in the late 1920s, Roaring '20s, where the Fed stepped in 1929 and egregiously raised rates, I think, in consecutive times, huge levels of magnitude. So of course that's going to derail the economy, derail the markets, and it created the big crash. And then in flash forward to 2000, we had March of 2000, and then for the next, I guess it was the next 2 years, actually 3 years, that the NASDAQ suffered. I think it was off something like, well, it was off more than 75% from peak to trough. So, and then that was the biggest correction the NASDAQ's ever had. So one could argue the Fed shouldn't be meddling in the first place. So soft landing in the long run, no, I don't think we get one. In the short term, maybe we'll get a continued rally for another year or two in the major averages. But whatever the Fed does, just got to keep our eyes on the price volume action of everything, and then account for the manipulation in QE, because that is the other wild card variable that is part and parcel of the markets we're in since 2009.
Dr. K, do you use the Hindenburg-Omen as an indicator?
There's been some statistical work and mild statistical proof, and mild at best. Therefore, my answer is no. I don't really pay that much attention to it. But if the news accounts start talking about it again, I'll look into it. I mean, I keep an eye on it, because I don't think there's enough events for me to say yes, it works, or no, it doesn't work. And so I'm still curious, and so that's kind of an ongoing observation and study that I do. So when we get more Hindenburg results, maybe as you get more results, you can make more definitive conclusions. So for now, my conclusion is that it is mildly predictive at best. So use it with caution.
Yeah, I remember somebody was talking about Hindenburg Omen in March of 2009, and that didn't work out too well. So, I don't really know. I think Ian Underwood is more familiar with that over at HGSI. Ian and Ron, I know Ian has talked about that indicator at times, but we've never used it. Someone's asking about intuitive surgical. I think that's a gap down pattern. This thing is. Whoops. Where did that come from? Is this a weekly chart, or am I looking at something else? Let's see. I think I somehow... No, that's right. This stock's breaking down. You can see the point of resistance becomes this. You now have sort of a cross of the 10-week, the blue line below the 40-week on the weekly chart, and you're breaking down. So is this a short? I think it's probably headed lower. I'd like to see if it rallied up into 480 and the high of today. I might be more inclined to take the short position, but you're only a couple of percent away from the high of the day, roughly. So you're within a shortable range, and it is gapping down on heavy volume, and you're starting to break down through this pattern. But you are at the lows of the base, so I would be more inclined to want to come after this on a bounce up into somewhere into this 480 level. Maybe even it fills the gap before rolling over again. But yeah, that's one to put on your short sale list. We're kind of keeping an eye on it right now. Angie's list. I don't have anything to say about it. It's a kind of a thinner stock, isn't it? Now it trades about $1.6 million, but it's a $20 stock, so I guess you're running about what, $35 million in daily dollar volume. So
no, not even. It's more like 17 or 18 million, which puts it in kind of like the gray area.
Okay.
It's just barely liquid enough.
Yeah, so stock's trending higher. You had this gap up here, Bible gap up that did not pan out, and so that kind of flopped out. and it's just moving higher. But I don't have any comments to say other than it's making a new high, so there's not really too much to think about it. So, just operate according to your rules, whatever those are in this case. I think the stock doesn't show a tendency to hold the 10-day, so the 50-day would become your ultimate downside guide. But, I think if you broke down to, say, this area on the top of the base around 20 bucks on some volume, you might take some profits if you're in earlier. But I don't think it's anything I'd be buying. It's not anything I would be buying because there isn't a buy point right here. So, put it simply. Let's see. Sound is going in and out, somebody says. Usually that's going to be your internet connection. So all I can tell you is I'm running a huge commercial internet connection out of my house, and it's pretty strong. So usually that's related to something going on in your own internet connection. So you got to get rid of that cheap internet. So stocks acting well on watch list ONXX. Yeah, this thing's acting okay. It's trying to. Let's see what happened here. These things. You know what the problem is over here? I'm over here looking at. So actually, you know what? I'm going to go back to Angie because here you're seeing this move. There are no pocket pivots in here, so not that I can see. So there are no buy points in here. Just wanted to clarify that. Let's see, ONXX. It's been acting well. Yeah, you had a breakout in here. It's a little bit of a funky pattern, but it's trying to break out. No earnings, losing money, biotech. So you don't want this to turn out to be one of those stocks where you wake up in the morning and one of their drugs has suddenly lost its luster and the thing blows up. So you got to be careful about that kind of stuff. But that's acting okay. Now, ServiceNow is it's a cup with a handle. Very thin stock though, relatively. Yeah, it trades a little over 1 million shares. Little erratic, and you did have sort of a, let's see, pocket pivot right here, it looks like. Did that clear? Just barely. So, if that's one you want to own, go for it, but it's kind of a smaller stock here. Let me take a look at this. They also lost money in the most recent quarter, negative 1 cent on $75 million in sales, which is a 92% increase in sales. What I want to know is why can't these guys get things jacked up a little better given those great sales numbers? That doesn't seem right to me. So I personally would avoid that stock unless there's some compelling story which I'm not aware of. How about you, Dr. K?
Yeah, I'm not. Again, this is a very treacherous environment we're in. So a stock has to really be quite exceptional if I'm going to get interested in it.
Yeah.
And this stock, it's just. I don't know. I don't like the earnings. The earnings line is just they're basically flatlined. They're basically at a break-even point. So that adds a more risk to this kind of name. And,
how about Value Click? VCLK.
That one.
It had a pocket pivot 3 days ago. I saw that, but there's really nothing going on earnings-wise. 22%. Last quarter minus 25%. I'm seeing sales decelerate. I'm not quite sure what's going on here. If there's a story, anybody know what the story here is? But you have a pocket pivot. If you're really hard up to buy something, I guess you could try and buy it, but just a hair extended now. But I don't really know what.
The fundamentals aren't all that exciting, so it's got some glitches.
Yeah. So, but you do have the pocket pivot. So SWI is a short. I wouldn't short SWI because I think it's too thin. And the other thing is, again, you're being reactive on the short side. Things are already broken down, and I'm supposed to tell you, oh yeah, short this thing. You had to be far more reactive, or anticipatory rather, on the stock. Notice how you broke down to the 200-day, no rally, and it starts to break down. That would probably be your likely short sale point, rather than coming in here. And again, this is a lot of questions I'm getting from people, not only on the webinars but also emails, mentioning stocks that have already been hit, and they're already down several days. So coming in to short them now is almost as well. It's tantamount to buying a stock that's sticking straight up in the air, and just turn this upside down. If you had a stock that went from here to here on the upside, that way, would you be buying it? No, it's way too extended. So not a short. All that is to say, VRX, Valiant. I saw it this morning. Come on now. I'm not sure what's up with the system. Not enough volume for any kind of a pocket pivot. You had this huge volume break, but you'll see where it has to exceed this volume here, and that's not going to happen. So, do you think FLT is rolling over? It's not a matter of thinking whether it's rolling over. It's a matter of judging whether the stock is violating a sell point. Okay. Again, we don't have a crystal ball. We can't sit here and look at a chart and tell you that whether we think it's going to go higher from here or we think it's going to go lower from here. All we know is what it's doing right now in relation to the context of its chart pattern. So therefore, on FLT, the stock, it violated the 10-day here. So here you had a gap up here and you violated the 10-day here, so briefly. And so I think you're using the 50-day moving average as your selling guide. So I would say unless it violates the 50-day moving average, there's no reason necessarily to sell the stock if you have a cushion in it. I mean, the other reason might be if the market gets into more trouble and you want to lock in a profit. But would you agree, Dr. K? There's nothing here to think about other than whether it's violated the 50-day or not, correct?
That would be correct. Simple.
So, and you guys know, those of you who've been on the webinars long enough, you know that you get me all rankled up by asking me, do you think this stock is going to go higher from here or lower from here? Should I sell it? Should I double my position? Should I call my mother? It's like, I don't know. You got to go by the rules. We try to teach rules here, and all you can do is go by the rules, or go by your own risk tolerance. Or rules based on your own risk tolerance and how much you're going to allow a stock to pull off before you start taking profits if you have a big profit in it. So, I mean, I've used this technique of selling anything I had if it goes up 10 or 15%, and not really thinking about whether it's violating a moving average or not. So. And in most cases this year, that has worked out pretty well. So, thankfully. But that's just the environment. Now, somebody asks, this is a good question, do you view the greater weakness, Dr. K, in the Russell 2000 as a reflection of rotation into large caps or a harbinger of impending weaker market action?
Say that one more time.
Do you view the greater weakness in the Russell 2000 as a reflection of rotation into large caps or a harbinger of impending weaker market action?
Well, when people are willing to take more risk, they're going to be more likely to buy the Russell 2000 stock, the stocks in that index. So when you see weakness in the Russell 2000 relative to other averages, that means risk is off, meaning investors don't want to take on a whole lot of risk in the current environment. And whereas the big caps are less risky names, and then from there you have the defensive names, which are even less risky. That's why you start to see defensive names become better performers in very treacherous market environments, because that's where the money goes. And then, of course, call it the fear trade. Piling into defensive stocks is one type of fear trade. Piling into gold, precious metals, that sort of thing is another type of fear trade.
Right, and I would view the shift into big caps, and really the Dow has been the index that has been leading this market, I think, and it's been one of the stronger indexes. Let's take a look at this real quick. Yeah, I mean it's been leading the whole way, and it's been a little more uniform. Notice that the sell-offs aren't as hairy in the Dow, almost imperceptible in early April. And to me, that is to me, I've taken it as a message that the market is focusing on just buying into big cap names, liquid big cap names, sort of QE stocks, as I would call it. We looked at this last week. We were looking at United Technologies with negative growth, and Johnson & Johnson with 4% growth, Mickey D's with weak growth. Now it's starting to come off. IBM was leading for a period of time, and it's getting blasted today on a big gap down move. But you can see that, let me get rid of this guy, move him over to the side. On the weekly chart, IBM is trying to trend higher this year with the market, but now you're breaking down. I've actually got this on my short sale list, watching to see if it sets up somewhere, possibly on a rally back into the 200-day moving average. But you're starting to see some of that come unglued, and today, obviously, the Dow is diverging from the other indexes based on that. So I think that's what it's been telling you. And so you're in a risk-off mode, and you're seeing a lot of defensive stocks, consumer staples, utilities have been leading, and I think that is a warning sign that people are shifting to a more defensive posture. So, and as I was saying at the outset of this webinar, that we do have a situation where the internals of the market currently with respect to stocks themselves are weaker on this latest pullback than they were on prior pullbacks, and I have to be a little bit suspicious of that. And like I said, that's why I'd rather be, at least on the long side, I'd rather be out of the market wishing I were in rather than in the market wishing I were out. So that's my take. We're going to keep flying through some names here. REGN, someone's asking us about. Stocks holding up, there's really nothing to think about. You haven't violated the 10-day, but you're not using that as your stop theoretically because it hasn't held above that long enough. The 50-day down here at 178 roughly would be your downside stop, but we can't tell you anything other than that. Short TDC, Teradata. I saw this before, but again, see, you're asking me the same question. Stocks down 3 days in a row. You can't short this here. You're taking on way too much risk, especially given the position of the indexes and the potential for a reaction rally like we were talking about earlier. So, but this one looked pretty good a lot earlier. You could say here's a head and shoulders formation, and maybe on this 50-day break and rally up into the 50-day, it could have been shorted there, but the market was in an uptrend, so a little difficult to do that, but it does look pretty weak. I would be watching this for rallies back up into say the 50. What would we be looking at here? Let's see. Up into this area 56 if that were to occur. But I don't think you can come after here. It's too extended on the downside. Is IWM showing a head and shoulders pattern? No, I wouldn't call this a head and shoulders, and we don't rely on head and shoulders on the indexes. The one thing you also want to see, if this were a left shoulder and this were a head and this were a right shoulder here, then you'd want to see this right shoulder lower than this left shoulder, and I think that sets up a proper head and shoulders. Let me give you an example. If we go back to Apple, see here's a little head and shoulders here that's set up off the peak. And notice how the right shoulder in here is lower than the left shoulder here. That's kind of what I would see as more of a head and shoulders on a daily chart. Somebody asked if Splunk closes below yesterday's close, would that be a violation of the 10-day? Well, it already has violated the 10-day. I don't think, however, let me see. Here's a violation of the 10-day here. Are you using the 10-day as a stop selling guide on this one, Dr. K? You want to take a look?
Yeah.
I don't think so. It's a squirrely stock, though, so, and like I said, I'm not so sure I want to be long anything right now in this market.
I mean, it hasn't violated the 10-day in at least 7 weeks, so you would use today as your selling guide.
Right. And we're going to go for another 10 minutes here, I think, until 9 o'clock. You okay with that, Dr. K? If you have to split, that's okay.
All right.
Yeah, I know you've got some things you have to deal with today. But because we got started late because I screwed up, and when I sent out the webinar invitation, I put 8 a.m. in the title of the invitation email, and we actually had
no, I'm fine. That place is going to be open a little bit after 5, so it's okay.
Dr. K, what do you make of falling commodity prices, deflation? That's one thing we're looking at here, and we've talked about that in our pre-market pulses, so I can answer that for you, Dr. K, I believe. I think that's one thing you have to watch out for this as a potential clue of deflation. So everybody's looking around right now for inflation. What I think happens is you might get deflation, the markets break down, and the breakdown in gold and silver, as well as some of the other commodities like copper and crude oil, and I think you've seen a number of them. It's telling you that that could potentially be an issue, and I think you have to be cautious on that note, because that's another thing that's a little bit different than what's occurred on the prior pullback. So caution, I believe, is warranted here, and I think Dr. K would agree with me on that basis.
Yep.
55 minutes in and not one Obama comment. Are you going soft on us, Gil? Well, I could inject a whole bunch. I know I was on the in the chat room the other day, and I just brought up the fact that I don't think Obama's policies are helping us. But we also have to remember that a number of George Bush's policies got us into this mess as well. But the way I look at it, the Bush-Obama duo is similar to the Nixon-Carter duo in the 70s. Richard Nixon was the one who gave us price fixing, and not allowing people to charge more for gasoline and whatnot, so we got shortages, and then Carter came in and he just seemed to exacerbate the situation. So I sort of see it as similar, that Bush's policies were pretty poor. Price controls, thank you. I'm just a little slow today. Too early for me. In any case, and Nixon did a lot of bizarre, what I think that are not non-conservative, conservative, anti-conservative economic policies that are more of a liberal sort of bent of price controls. The idea that you're going to control prices like the Soviet Union thought they were going to, and you just create shortages. But I think today what we're seeing, the situation is such that Bush's policies were poor and created, and the Fed's policies as well during that period, created the bubble that collapsed in 2008. The whole mortgage thing was a government-caused phenomenon. And then Obama's policies have only served to pour kerosene on the fire, and that's it. There are no solutions being offered from this administration and this Congress, and I would say on both sides of the aisle. But I hate Democrats and I hate Republicans, you guys. So not really a partisan, your typical partisan investor. Most people can't figure that one out, So Republicans think I'm a left-wing hippie, and Democrats think I'm a right-wing nut job, and maybe I'm just a little bit of both. Who knows? But in any case, that's enough of that. I would appreciate any comments on WM as a possible short setup. Not really. It's a stock in an uptrend. You're using the 50-day moving average as a selling guide if you were owning the stock, and so there's no setup there. SCSS. Oh boy, there's some little ones. No, I wouldn't trade this as not a short because, number one, it's too thin. Trades 754,000 shares a day. Is that right? No, 1.4. It's $18 stock. It's already down considerably. I'd be looking for some other things. Look, when we think the short side is getting ripe and when we think we're in a serious bear market, we'll be showing you some short sale setups. And until we do, until we're confident enough to come up with something like that relative to, say, what I'm doing now, which is basically hit and run on the short side, and we think there's something like another Apple out there, which we showed you guys a long time ago when it was up in the 600 area, that's the sort of thing we're looking for. And so I think right now, some of these things that are already down, you had to be on this one a long time ago, but it's a relatively thin stock. You can see here's a big cup with a handle, and it failed and broke down. And you had one breakdown on this weekly chart here. Let's just go back up here so I can show you how this worked. Go back up. I believe this is where it topped. Is that right? Let me see. Let me shrink this guy. Let's see. It's way back here in August of last year. So right about here. So here's where you tried to break out, and then you failed through the 50-day, one rally up in, then you could have shorted it there. So that would have been a better spot. Remember, you got to be on top of these things, and you have to be anticipatory. You can't be reacting to things that are already down and dirty because the risk is just too high. Ew, as a short, Edwards Life Sciences. I think this has some potential because you're looking at this sort of left shoulder here ahead, and it's taken a while to break down, and you can see now you're picking up some volume. Your stop is a 50-day moving average. This one might be a better setup. The only problem is, in my mind, it hasn't really been that consistent of a big stock sort of leader. I mean, when you think about the perfect short sale setup, Apple is it, where everybody loves the stock, and it requires some courage, I think, also to short a stock when the whole world believes that it's never going down and it's going to $1,000, and I think that's what sets up the whole thing. EW, Edwards Life Sciences, is a little more obscure, but it has those characteristics that you might look for in a short. But you can see how even here you have this gap down here. You rally into the 50-day, but it doesn't break down, and it continues to look like it's going to break out. But every time it fails, it's telling you it's weak. Now we break down to the 50-day, another rally up into the 50-day here, and into this area of resistance along the lows around 90 here of this little range, and then it breaks down again. So you can see the 50-day tends to now be an area of resistance, and really it could be set up to move lower. That's a possibility. You were going to explain your 620 and spikies. Spikies? Is that what that is? That sounds like the way my wife used to talk to my kids when they were babies. Everything had an IES at the end of it, Like we're going to eat our lunchies now, and let's put on your diapies and stuff like that. But anyways, spikies, maybe I'll get to that. It looks like natural gas might be breaking out, somebody says, and let me see. Actually, it is breaking out. It's breaking out of this range, but it's way down here. I don't really know much about this, and I don't understand enough about the natural gas market to get involved. But if you do, maybe, it's a breakout to buy. I don't know, but that's what's happening. I've never traded it. Do you have to wait to trade stocks for yourself that you also trade for client accounts? Only if we're implementing the trade at the same time. So we can't front run client accounts, but I may have a rationale for doing something earlier in the day, and we're waiting for another signal, say more of a confirming signal for client accounts, because we run them completely differently. So there's differences in risk taking. There's differences in position size. There's differences in the signals that we're operating on. So I mean, think about it this way: if we have a managed account that takes a 10% position in XYZ, and I take a 150% position in XYZ, and it starts to come off, the managed accounts can afford to sit a little bit longer because they have a 10% position, which is very small. But if you're running a 150% position, you can't sit too long, or you can get your head handed to you, so you have to start backing away. So, but that's a general rule, and that's a compliance rule, that if you're executing trades at the same time, you have to let the client accounts go first. They must go first. You can't conflict with that. Given the market behavior recently, should one pass on all pocket pivots or take on a case-by-case basis with tight stops? I think that's really a question that you have to determine on your own. I don't think there's a one-size-fits-all answer on that, because there have been some pocket pivots that have led to some pretty big upside moves. Regeneron Pharmaceuticals is one such example that I would point out. Here's the pocket pivot here. If you took that, boom, you're off and running. But again, it's very difficult. I think the best strategy is probably try to pick those with the best fundamentals, and Regeneron did have some great numbers, earnings and sales growth numbers, and a compelling product, Eylea, their new eye drug for macular degeneration. And so I think the key here is keeping tight stops if you're going to try some out, and try to focus on companies that are in strong groups. So biotech has been strong, and also that have outstanding fundamentals. Doesn't mean that you're going to hit them all. How do you decide to cover your short position, price level or percentage gain? Well, both. And I've gone through this sort of stuff repeatedly, and I don't know if I can think of any examples here. What were some recent shorts I'm thinking? Well, I mean, let's take a look at Netflix. So here's Netflix, breaks down and runs up, comes down for 3 or 4 days, and tests these lows in here, and that could be covered there. It's usually, is it coming down to an area of support? Is it undercutting an area of support? Or do I have a 15 to 25% profit in the stock, depending on what I think I can get? That's how you cover shorts. And what you should do is read, I think it's chapter 6 of our book, Dr. K, where we talk about short selling and setting price targets.
Yes,
I think you should read that chapter.
That's correct. Chapter 6, Riding the Bear Wave.
Yeah, and so that's how that would work. Anyways, let's see. Do I have anything else to talk about? Somebody wanted me to discuss the. I think there's some interesting things. Let me pull up my handy dandy 620 chart here. And I was talking to somebody yesterday on the chat room, or in the chat room, and we were talking about this chart a little bit, and most people didn't know what the heck we were talking about, because we only talk about it in the webinars. It's not something that we've ever put on the website. But a way to trade, you get the UVXY gets a lot of very erratic moves, and so one of the ways that I've been studying this and trying to time my entries and exits a little better, and also buying into weakness. If you notice the MACD lines here, you see these little maroon lines, or whatever, pink lines, whatever you want to call them. When they get pretty high, and it's sort of a relative thing, they start to get pretty high like that, and I'm selling into these moves in here, and then it comes off, and then notice how they get very deep in here. Then I might be buying into that and testing it out of position here along the lows, because what you notice intraday, you get a buy signal here, then a sell signal, then another buy signal, and that buy signal worked pretty well. But again, you got the situation where the market's just very volatile, and so I'm just looking to take out the big chunks of price movement that I can get in these. But if you bought into this one here on this extreme low in the MACD, you could have sat with it the whole way, because a lot of times what I'll do is I'll see this reach a big extreme, and I'll jump in and buy some here, and then just try to sit with it. And my basic rule is, if it comes back to where I bought in, I'm gone. End of story. I'm not going to let it turn into a loss. That's basically my stop. And so what happens is, by using that rule and buying on this extreme MACD weakness, and you can see the lines kind of veer very far from each other, and you come in. I was able to hold it, through most of the day and make this profit. So I was able to catch this move here right off the opening, and then sell into the peak here on the MACD reaching an extreme, and then buy back in here, and then ride this into the close, and then sell towards the close. Because a couple of things, you also, when you're trading things like the UVXY, you have to watch what the market indexes do. I know there's some cases where the indexes will go one way and the VIX goes the other, or goes in the same direction, but generally they're moving in opposite directions. So yesterday, getting towards the close, and for those of you who were on the chat room, I was pointing this out to somebody on there. Don't remember who it was. I know there was like TOP or something like that was their handle on the chat room, but pointing out that I thought, you know, you had just reached the peak in the thing at around 870 and change, and that pretty much was it. But a lot of that is based on the fact that I'm noticing that the indexes are trading lower volume than the prior day. I'm noticing that the NASDAQ Composite is undercutting that early April low. So basically, you know, looking at the chart yesterday, whoops, I never remember this one. There's no X in it. I think because stock charts, theirs is Comp X, and so I get them confused. But, you know, yesterday you're seeing as we're going into the close, you're undercutting this low here on the NASDAQ. The S&P is, whoops. You know, the S&P is holding along the 50-day moving average, and so I combine all of that. You know, and unless you can do that, you know, you shouldn't really be trading this thing. But you know, I try to show you guys some tricks that you might try and use. Those are on that chart. This orange line is a 6-period exponential. The blue line is a 20-period exponential. I'm not sure what this MA780 is. I think one of my kids must have been messing around with my E signal. So my son fancies him a Dr. K-like. He fancies himself to be a Dr. K-like market statistician. So who knows? Maybe he's in there messing around.
Excellent. Glad to hear that.
Yeah, they all want to be
like all of that.
Yes, I'm sure you do. So. In any case, so that's basically how I'm working it. So that's, I think that's basically all we have. So, you know, the bottom line here is we're watching this rally. I'm watching, just to show, you know, I'm watching LinkedIn in here. It's sort of fluttering around, but it's underneath the 10-day moving average. I'm wondering, is this going to blow down to the 170 level or this low? I don't know, but might be shortable. I think the Netflix on the rally here, I'm watching this, pulls into the 10-day right here, and I think that becomes shortable in there. So, you know, put a position out on that. We were watching it do that while we were doing the webinar, and maybe it's going to break the 160 level, but not sure if I'd hold it. You know, looking for a hit and run move below 160, maybe lower before earnings next week. Otherwise, I don't think I'm going to hold any shorts into earnings. You know, as Google pointed out. Let's take a look at Google real quick, see what that's up to. You can see it's still charging higher. Let's take a look at it real quick. We'll just finish up by looking at it on the old 620 chart. And you can see that this morning you had a clear buy signal at the opening, and it still has not violated the trend so far. If we look at, say, Netflix in here, you can now see that we went to a sell signal in here. And I think even that for Dr. K, is this confirmed? Because here's where you cross below, and here's the bar here, and then you move below the low of this bar. So that almost looks confirmed, and you know, obviously using like 168 as your stop as a quickie on the upside. But you can see that's the reason I'll come after it in here on the short side, because I've been campaigning this one over the last few days and coming in and out. But you can see how I also use this on the short side to short into rallies. It doesn't mean that's going to roll over from here, but it gives me a reference point to short into rallies, because I can tell you in the past I would short into rallies, and the stocks would just keep on moving and moving and going higher, and I never had anything to tell me when there might be a change of intraday trend. This tends to work, and at the very least it keeps you out of trouble, because if the thing reverses back to the upside and you get a buy signal in here, then it just gives you a quick out point. So that's how we use it. Anyways, you'll hear me talk about it from time to time in the chat room, but I like to think that the webinar members are privy to the things that we talk about on these webinars, and I don't want to just start spewing that all over the chat room. The chat room is for all of you guys to trade some of your ideas, talk about experiences. Maybe some of you have some insights on certain stocks, and maybe Dr. K and I can steal a few of those insights as well. So we'll come in lurking from time to time. Dr. K, have you had the chance to get on into the chat room yet, or the lounge yet?
Yeah, I've checked it out, but I don't really have much time, you know, obviously, because I'm also pulled in a lot of different directions on some of these other sites, and I'm always redirecting people just so they don't make a habit of it. I just don't have the time to chat with hundreds of people. So I
Right.
immediately try to redirect. And yeah, as far as this chat room, it's going to be the same thing. I often just am not going to, you get into chat room and it's easy for 20 minutes to get sucked away just like that. So
Right. But you have a lot of fans there, and a lot of fans on in the chat room, and I think you should grace us all.
There's close to 700 on my Facebook, just on my normal Facebook, and a lot of them around here actually. When I gave that talk at Queen Elizabeth Center, they came up to me. They were like, "Oh, we follow your Facebook. We love your Facebook." So that was kind of interesting. I enjoy that. I could post something up and I get a lot of response on it.
Right.
It makes it a lot of fun. That whatever I'm doing, it's if it's helping people in some way, that's great. That's what it's all about. But then, of course, I have to measure my time very carefully, and I just know that these chats are they're like time vampires. They will steal time away before you know it.
Somebody's asking about this 780. They obviously weren't paying attention when I said that. I think something my son might have just thrown up on my charts, and he's looking at something. I took it off now, so you don't have to worry about it. It doesn't matter. It has no relevance. Somebody put it up there, not sure what, but I gotta make sure I don't leave my e-signal on when my kids get home from school. In any case, I'm going to go over this one more time because somebody's asking. We're looking at, we have the orange line is a 6-period exponential, the blue line is a 20-period exponential. The MACD is set up the same way, 6, 20, 10, and C, which stands for close. And that's basically all it is. It's very simple. So the moving averages are exponential, 6-period and 20-period, and then the MACD is a 6, 20, 10, C. You can always go back and look at this video again, and you'll see this up here. And this is just a very rough sort of 5-minute chart that I use. And we just got, like I was saying, we just got a, oh, where did it go? Just got a little sell signal on Netflix intraday. We'll see if that works. So don't know if it's going to, but of course that's my stop is if we get a buy signal. Anyways, that is all we have. The chat room, to get to the chat room, let's see. If you go to, I'm just going to show you guys this. Can they see this? Let me see. Yeah. Can you guys see this? If you go down here, this is, it should say welcome your name, and then you go down here and you click on the Java or the Flash icons. Dr. K, you can see that, right?
Yeah.
Okay. And that'll take you into the chat room. So let's see what happens here. I get this. And taking a few seconds here. Watch, as soon as I get in, everybody's going to say hi. I try to hide sometimes. And we've got 28 people in right now. It's pretty quiet, probably because of the webinar. But that's how you get in, you guys. So hope to see you there. I'm going to spend a few minutes on here right now and see what's happening. So on that note, I think we'll finish up today's webinar. We went over a little bit, and that's pretty much all we have. So good luck, you guys. We'll see how things go. I think you kind of want to take it slow here and see how this develops because you are in a logical area from which the market can rally. And so kind of watching some of these short setups and see if they work. And I'm not averse to using my 620 model to put out some shorts in stocks that I've been campaigning over the last few days where I am getting an intraday sell signal. So, but that's, and this keeps you out of trouble because, if I'm in at, say, 167.70 or 50 and it turns I'm out at 168 and the loss is minimal. So that's how I try to control it. Doesn't always work that way because sometimes intraday, there's some news and you suddenly see your stock jacking to the upside. I had that happen a couple of times to me on Apple because there was all that news a few weeks ago about them declaring a big old dividend or whatever. So anyways, but that's just one way to handle the short side, which as you know is fraught with a lot more risk than the long side. And so unless you have deep pockets to deal with it or you have the stomach for it, just be advised, okay? Anyways, on that note, you guys, we'll catch you next week. Take care and have a great weekend.
So long, everyone.